Hello, everybody. I'm Jerry Cronenberg, Director of Financial Content here at Moomoo Financial News, Moomoo Technologies Inc., I should say. I'm sorry. And I'd like to welcome you to our latest webinar with our market expert, Stephen Sarge Guilfoyle. Steve, hello.
Good morning. Glad to be here. Thank you.
Now, as we are talking, we just got the Consumer Price Index numbers for April, came in about as expected. A little bit of debate what the consensus estimate was. But we're going to talk today about that. We're going to talk even more so about what are these inflation numbers? What is the CPI? What is the PPI? What is the PCE, etc.? What do they mean? Why should you care? So Steve is going to help us with this today. Steve is our markets commentator here at Moomoo. He is on our site every day in the Moo community under the Invest with Sarge handle. Check it out. He is a former New York Stock Exchange floor trader, a former staff economist at several firms, and is currently a columnist for TheStreet.com Pro. So check him out every market day. Before we get started, though, I'm going to encourage you to send in questions by the chat function of this live chat. This is, and we want it to be a live chat and interactive. So send your questions to Steve about inflation, how to invest, and things of this nature, and we'll try to answer them as best as we can. If you do send a completed question, you will get 100 Moo points just for submitting one. If we use it on air, you'll get 1,000 Moo points. So send those questions in now. Steve, while we wait for some questions, let's talk a little bit in general about inflation. We'll get into the CPI as well. But first, why should markets even care about inflation? Why do they care? Why does the Fed care? Why is it playing to investing? Let's start from the basics. How and why does this factor into the markets historically?
Well, the Fed has to care. It's part of the Fed's mandate. Stable prices and full employment are the Fed's two mandates here in the U.S. So they have to care deeply if inflation gets away from them. Or if you recall a few years back, Janet Yellen, when she was running the Fed couldn't create inflation. They were trying to get the inflation up to 2%. So 2% has been their mandate since long before inflation became a problem to the high side. It was a problem to the low side for many years. So they do have to care about that because they do try to manage the economy successfully, not successfully. They do try to manage it through what's called monetary policy. Monetary policy is the enabler of fiscal policy, and that's how the government runs itself. That's how the government funds itself. So it is, although the central bank here in the U.S. is independent of the government, at least on paper, it is still part of the interlocking economic mosaic, you might say, as how we run our country here. So the central bankers, they do have to make decisions on short-term interest rates on the size of their balance sheet, partially based on employment, partially based on inflation.
Right. By law, I believe that their mandate is called the dual mandate, and they are supposed to aim for what they always say, which is maximum employment in the context of price stability, which I believe they publicly said means about 5% U.S. unemployment or less, or roughly 5%, and about 2% inflation. That's their goal. Now, we don't get into a big economics lesson because we could talk about this for hours, but just talk really briefly about what they do and the Fed funds rate, cutting this, raising it, and that. Let's do just a short rundown of that. That's kind of their main policy. I know they also do something called quantitative easing and quantitative tightening. So right now, when we appear to be we are in a higher than a 2% inflation environment, what's that typically meaning for the Fed in terms of interest rates, cutting, raising, all that stuff? Just give it just a short overview of what they look at and what they do in response to what they look at to the CPI and other numbers.
Well, the benchmark overnight rate here in the U.S. is the Fed funds rate. Every central bank calls it something different in every monetary zone or every nation. We call it the Fed funds rate here. The Fed targets the Fed funds rate as a way of controlling the short end of the yield curve. The long end of the yield curve is still largely priced by the free market, and that's why it's been inverted for so long. But the short end of the curve is how the Fed monitors or controls. It's really how they either step on the gas or ease off on the gas as far as creating demand across the U.S. economy goes. So right now they think rates are restrictive. I'm not sure they're restrictive. I think maybe they aren't, but that's my opinion. The Fed thinks rates are restrictive here. So they have rates up at 5.25% to 5.5% on the short end of the curve to try to slow down, to try to tamp down on economic activity just a little bit so they can bring down inflation, because according to the data they have, the economy here in the U.S. has been strong for the last couple of years.
And when we talk about short end, my training tells me that's things like, or impacts things like money market interest rates, 90-day treasury bills, credit card interest rates. So raising those rates tends to make credit more expensive for businesses and consumers, and they tend to slow spending, which that should theoretically cut inflation. Is that correct?
Yeah, that's pretty much correct. I mean, a lot of people look at the 10-year as the benchmark, and the 10-year is relative to other countries. That might be how you want to base your currency trades on, something like that, on the various 10-year spreads from one nation to another. But as far as consumer credit goes, as far as pricing mortgages goes, stuff like that, credit card debt, as you already mentioned, the short end of the curve is really where you find the action. It's where you find the rate that banks will lend to each other. It's where you find really where investors who have stayed out of the stock market, where they have put their cash, because they've been getting paid 5% plus for 3 month, 6 month, or even 1 year money, where they could sovereign debt, your T-bills. So T-bills have been a great way for investors who are a little bit fearful, or maybe they're not so open to risk. It's a great way for them to add 5% to their holdings, rather than a few years ago when they could barely get 0.01% on their savings.
Right, now let's talk about that a little bit. And this is why the Fed, the markets are watching the Fed and looking for a rate cut, right? Because historically, as rates go up, money goes out of the market and goes into bonds, goes into T-bills, goes into money markets. And if it goes down, maybe it goes the other way. I mean, is that correct? How does it work in terms of why is everybody, hey, we want the Fed to cut rates? Why don't you explain that a little bit?
Well, I think they'd like the Fed to get into cutting rates a little bit, because it forces people, if it gets low enough. I don't think one 25 basis point cut would do much at all. But if short-term rates get low enough, it forces investors and savers into risk assets, because they can't make anything on their money stashed away in a savings account somewhere. So they will be forced into things like stocks, like commodities, like they'll be forced to play the currency game. Pitting the U.S. dollar versus other currencies. They're forced to do things that they're not always adept at, or that just come, even if you are experienced, with a whole lot more risk than just stashing your cash away. And if you're not a professional trader, if you're not a professional investor, this can be quite dangerous, because let's say you're Joe the baker. I mean, you spend 8 hours a day baking bread, but you invest for yourself on the side. Well, Joe the baker's not watching the market all day long. He finds out maybe that night when he puts on the news what happened to his portfolio. So it's a dangerous game for common folk, for lay people, to force them into riskier assets.
Got it. Now let's talk a little bit about all these measures and what people should pay attention to. We got the CPI today, Consumer Price Index. We got the PPI, the Producer Price Index, yesterday. We'll get something called the PCE, Personal Consumption Expenditure Index, in a few days, later this month. So the Fed says, okay, we're looking for 2% inflation. But by which measure? Can you talk a little bit about these measures and what they mean and what the Fed has thought to look at and things of this nature?
Yeah, sure. The Fed's been looking, when the Fed talks about a target rate, they're talking about PCE. That's the measure of inflation they watch. Unfortunately, the measure of inflation almost everyone else on the planet watches is CPI. CPI is a little bit heavier on the shelter side. PCE, I think, is a little more like healthcare focused. So they're not exactly the same baskets, but they do run with the same trends. Of late, PCE has been running lower than CPI. So while we look and we see 3.4% or 3.6% inflation, the Fed might look at it and say, 3% inflation, because they're around 2.9, 3.0. We don't have the April numbers for PCE yet. But the Fed sees themselves as less far away from their target as the rest of us do, because the rest of us look at CPI. It's been around longer. It's what most nations use to measure inflation. And it's just what really folks outside of the economist community use to measure inflation. So there is a little bit of a disconnect there.
Okay, great. Let's talk a little bit about one other term that we hear bandied about, core CPI. But it's not just CPI, but there's core CPI. Why don't you talk a little bit about that, and why is that measured?
Well, I think core is actually what the Fed prefers to look at. It's what most of us prefer to look at, actually, because it excludes energy and it excludes food prices. And those kinds of prices aren't, if you've been to your supermarket or your gas station, those prices change day to day, week to week. They're much more volatile. So there is a core set that folks look at, that the economists look at, and they judge that, is that real inflation? Well, the whole thing is real inflation. You really have to pay those gasoline prices. You really have to pay so much for the food you buy for your family. But core, it gives you a more, maybe it's better at setting the trend, or making the trend identifiable, because a couple of words out of Saudi Arabia, a couple of words out of Kuwait, something like that, that can change the prices of oil and the price of gasoline almost on a dime. You'll see gasoline. Sometimes you think it's going up, and you look and it's been down for the week because a couple of words were spoken about forward-looking oil demand or supply that maybe you missed, something like that. So energy pops around. Food is less volatile than energy, but energy, as you saw today, let me see if I can find my notes here. Today, the PCE, okay, energy was up 1.1% month over month. Gasoline was up 2.8% month over month, but the CPI was up 0.3%. So you can see how out of touch with the regular or core CPI it was.
All right. Now let's talk a little bit about how the market reacts to these numbers. We got the CPI this morning. It was seen as benign, either on target or a little bit better than expected, depending on whose estimate you're looking at. The market went up somewhat. The main indices, at least the futures, did. How does the market typically respond to a quote unquote good or bad CPI or other inflation reading? Both now, let's talk historically. As you were saying, some years ago, not that long ago, inflation was seen as too low. That was seen as bad. If you're in the middle of a recession, inflation could be a good sign, could be a leading indicator. So historically, let's talk first in the current era and maybe in other types of eras. A benign or a high inflation number, what's the typical reaction that people have historically seen in the market when that happens?
Well, in theory, an on-target inflation report like we had this morning shouldn't move the market much because it should be priced in. And yesterday the markets ran up to the high side. We ran a little hot not due to the PPI, because the PPI was, there were some revisions, but the PPI was a little bit warm. So you would think that maybe that would have hurt the market. But then Fed Chair Powell came out and made a speech in Amsterdam around midday, where he said he wasn't even considering rate hikes anytime soon, because there's been some consideration of that, not in the mainstream economic community, but on the Wall Street community. There's been some concern that perhaps they might end up having to raise rates. He kind of put that to bed, and there was a rally. Now, this morning, we got inline reports for CPI, both month over month and year over year, and the market's rallying further, at least on the futures side, because we haven't opened equities yet. And I'm a little surprised by that, because I had heard myself on whispers of actually a lower print for CPI for today than we actually saw. So I thought they might actually take this negatively, which they haven't. It's going back to stocks. The NASDAQ and the S&P. NASDAQ closed at a record high yesterday. S&P is probably going to be around a record when it opens. Both of them are at that point where they either break out technically or they form a double top reversal. So both of our major indices here in the U.S., equity indices, are at inflection points. So they do react to these things, but they're going to react a little bit funny this time because they're at important technical places on the charts.
Let's just talk historically. As I said, if we're in the middle of a recession, the economy is terrible. Who knows what the market's doing? It can be up or down based on how close we are to coming out of a recession. But a hot CPI print could actually be good news sometimes, or am I wrong about that?
Well, it can be good news if it's reflective of economic growth when you're in a period of low growth, but it could also end up being stagflation or slugflation, as Doug Hess likes to call it, where you have little or no economic growth and you have inflation. That's pretty much the worst of all scenarios for an economy, except for outright recession. So that's not what we want. But yeah, that would probably be taken very poorly by the marketplace if you had a hot inflation print in an economy that was known to be moving slowly and producing poor corporate earnings.
All right, great. We're going to get to questions soon, but I want to ask you two others. We mentioned PPI, or Producer Price Index, which came in yesterday. It was seen as a little bit hot for April. Why don't you tell people a little bit about what PPI is and how investors historically can use it to tell them where things are going?
PPI can be a leading indicator for CPI and PCE. It's basically your producer / wholesale price index. it's not what you and I feel when we go to the store or we order something online, but it is what the people who sell us something online or sell us something at the store feel. So it impacts corporate margins greatly. And if you assume, which you can't always assume, but if you assume that prices are then passed on to the consumer, well, then it could be a forerunner by a month or two, although it doesn't always work out. But it can be a forerunner by a month or two for what the consumer level inflation indicators might tell you.
All right, great. Well, one more question from me, and then we're going to get some questions from the audience. So go ahead, folks, and send your questions to Sarge using the chat function. Last question from me. I understand that high inflation is not really bad for every single stock. I mean, when I was learning things, historically, they said in a high inflationary environment, REITs, real estate, and energy can historically do well. I'm not sure that real estate's doing well right now, but talk about that. I mean, inflation is not bad all the time for every stock. Is that correct?
That can be true. I mean, energy, you're right. I mean, when you right, like inflation has been a problem of late, right? So what I have done in my own portfolio is get long inflation. You know, if you know what the trend is doing, you play the trend. So you get long the metals, you get long agriculture, you get long things like that. Energy, like you said, where you basically the companies or the ETFs, because I won't mention ETFs here, but the ETFs and companies you invest in benefit from higher prices. So you want to be able to at least move part of your portfolio into something that will benefit from an economy that's suffering from high inflation. You want to be on the right side of the game. And you obviously you can't do that with your whole portfolio because you have to play some defensive ball. You have to balance your portfolio in order to hedge properly. But you definitely don't want to just leave things as big. And as far as the real estate sector, which you mentioned, I'd be careful there because commercial real estate could be a real problem right now. So if you're in the REIT game, you probably want to check your REITs and make sure you're not too heavily exposed to either regional banks or REITs that could be suffering from a move from local in physical retail onto the internet side.
Right. And again, Steve can talk in general terms, but he does not know what your portfolio is or your risk tolerance, so he cannot give you personalized recommendations or advice. All right, let's go to some questions from the audience. This is going to be great. First one is from Dr. Pot, our old buddy, Dr. Pot number one, I should say. All right, excellent question. Are we perhaps overly fixated on the Federal Reserve's rate adjustments by closely monitoring CPI and PPI, thereby potentially overlooking the broader macroeconomic factors that could influence the market's dynamics? So again, high inflation or relatively high inflation, higher than expected inflation, everyone assumes it's bad for the markets, but it could be a sign of economic health. What are your thoughts about that? I mean, is it all about the Fed, all about rate cuts? What do you think?
It's not all about rate cuts, but it's very much about rate cuts. I think they are the most important input into the marketplace price discovery that we have. And remember, monetary policy is the enabler of fiscal policy, and those are the two policies that will impact you as much as anything else. As I've mentioned in the past, economic/policy discipline is as much a discipline as technical or fundamental analysis. And for true investors, for well-rounded investors, I think you need to master all three disciplines. So yeah, you do want to pay attention to whatever impacts monetary policy, and if monetary policy will be capable of enabling fiscal policy in the way that the Treasury Department has become accustomed to, which I think will become a problem over the next few years.
Talk really quick about fiscal policy. That is the spending of the U.S. government because it is one of the biggest players, if not the biggest in the economy, right? So that is what the government spends, what the government taxes. Spending can be inflationary, right? Especially borrowing and spending. Taxes take money out of the system and can be deflationary. Is that correct?
Yeah, high taxes will definitely hurt an economy. But when you run a deficit like the U.S. has, I think there's almost no way around taxing the public. So they're kind of caught between a rock and a hard place. They need to raise more money because they're spending so much. But in order to raise more money, they have to hurt the economy. So you're going to have a fight on Capitol Hill between the folks that will say, well, we'll just live with huge fiscal deficits, and the folks who say, hey, we got to fix this before our economy, our currency blows up.
All right, next question. We kind of touched on this, but maybe you can expand on it. In what ways can investors hedge against inflation risks in their portfolio? Now, of course, Steve can't give exact specifics to your portfolio, but let's talk in some general things about what are some historic or traditional hedges that people will look at for inflation.
Well, a couple of them I just mentioned a few minutes ago. Yeah, precious metals, agriculture stocks, some commodities. You want to spread it out amongst these things. These among what will benefit from an inflationary environment. So that's how you can hedge. Another way for younger folks, perhaps. I'm not going to say younger folks because there are plenty of folks my age who invest in crypto, but Bitcoin is used as a replacement for gold or silver for, generally speaking, for a younger group of investors where folks my age tend to look at precious metals as the alternative investment, but they both can serve the same purpose. Now, I think there are more things that impact Bitcoin's price than gold's price. So it's not a pure play, but it is one of the things you can do. Now, I don't want to say to hedge inflation, but to row the boat in the same direction as inflation, so you get hurt less.
And we haven't talked about this one in a long time. This was popular some years ago, but they're called TIPS, Treasury Inflation Protected Securities, I believe it is called, which is a treasury bond, United States Treasury bond that has some adjustment for inflation. Again, without getting into whether those are good or bad, we don't hear about those that much. I mean, is that something people are using for hedging?
Yeah, it's out there, and I don't really dabble in it much, but it's a way to play the treasury game, which is considered safe. Okay, treasuries are considered to be safe investments. You get your money back, you get a little bit of interest. Well, the tips are a way to play that game with a little bit of adjustment for inflation, because when these were created, inflation was a much bigger problem, and you don't want to sit in something for 10 years at the same rate if it's nowhere near keeping up with the pace of inflation. So this was meant to protect folks and to keep them interested in buying treasuries and helping fund the government at a time when inflation was even a much bigger problem than it is these days.
All right, our next question is from ZNWC. And again, you can't give a crystal ball here, but based on current inflation indicators, do you think the Fed will cut interest rates by the end of this year? And if so, why? Maybe make a case. What should people look at? Yes, it's going to happen. No, it's not going to happen. What should
Okay,
people be looking at?
now I think if we saw a slightly cooler CPI report for April than we had in March, that's the ball rolling in the right direction. Can the Fed cut rates? I don't think so just yet. I think they have to be on guard. It's, as Jay Powell told you yesterday from Amsterdam, he's probably looking at holding rates steady for now. And as we roll into the U.S. election, which comes November 5th, that's sooner than you think. I think that only really leaves June, and maybe July, where the Fed could probably take action without looking like they're impacting politics, which is something they definitely want to do. They want to look apolitical. So even July might be too late. If they don't act at their next meeting in June, I think the ball game is over until when they meet in late November, which will be after the election. Then they can take the kind of action they think. So I think, let's say between July and the election, I think the Fed's hands are tied, whether they think they should act or not, unless there's an actual economic crisis. I don't think they'll act over the summer or into autumn.
Why don't you talk a little bit about, you're probably familiar with the CME FedWatch tool, which is something that people can find online. You can Google it. And this looks at probabilities based on what's going on in the futures market. Why don't you talk a little bit about that?
Yeah, we all use this. I mean, it's a great tool, and Bloomberg has a tool as well. But what it does is it based on futures pricing in Chicago, it prices in the probabilities for rate cuts or rate hikes of 25 basis points or more over every meeting for the next, let's say, year and change. And it will tell you that right now, let's say there's a very small percentage of a rate cut by June or July. And it will show by after the election, it becomes a much higher percentage. Last time I looked at it, it was up to 50 basis points worth of rate cuts by the end of the year, which would be December. I don't know if that happens, but I do agree with the Fed's fund futures model, which is not always that accurate. But I do agree that if there are going to be changes made, it's going to be backloaded after the election.
All right, great. And last question from this person. We're going to have a few more questions, although we're getting late on time, so send your questions in. What is the risk the U.S. economy will slip into stagflation, no growth with high inflation? Should we be worried? Now, of course, Steve doesn't have a crystal ball, but what signs would people look at that would show them there's a stagflationary economy?
Well, I think we are. I think this is definitely a risk. I think that just my personal opinion, but I am an economist, and I do read what other economists write, and I do look at the data. Uh, I think that 2023 GDP, which was kind of robust, is probably going to be revised lower. I think that so far this year, maybe the numbers, I think the Atlanta Fed is right now at 4.2% for this quarter. The first quarter was fine. I think those might be revised lower because the labor market was apparently, according to the Bureau of Labor Statistics, nowhere near as strong as they first reported on their monthly non-farm payroll prints. That's going to impact everything. So if our economy is running at a lower run rate than we believe, then we're already halfway towards that stagflationary environment. All you need is a little bit is inflation not to cool off all that quickly. Now, to be in a stagflationary environment, we don't have to go into recession. It doesn't mean GDP has to go down to zero or into contraction. But if GDP runs down to, let's say, sub 1.5%, and you do still have inflation running at 3% or hotter, I would say you're probably in a stagflationary environment. And that's a tough thing to get out of. It's you may have to go into a Reagan-esque supply side economics type period in order to try to get out of that. It's which is really not a finite form of economics. It's really kind of like throwing something against the wall and hoping it works. But it might be something we would have to try. So you're right to fear this. Let's hope we don't actually go there, because once you go there, you're not far from an actual recession.
Great. And just for our less experienced investors, GDP is gross domestic product. It's a measure of everything made, all goods and services in the United States. And the percentage gain is how much it goes up every year. Typically, if I understand correctly, if memory serves, Steve, 4% or higher would be a good annual growth rate. Below 4% starts to get weak, and lower than that is even worse. Is that a good rule of thumb?
4% would be outstanding. Even 3% would be outstanding. During the Obama years, they did a study and they felt that the potential for the U.S. economy was a little above 2%. So really, we would look at below 2% as a sluggish economy, and anything around 3% or more, I think, in an economy this size, because you have to realize that at scale, we are a huge economy, especially per capita. I think anything approaching 3% would have to be looked at as outstanding. But you have to measure it against GDI, which is gross domestic income, which for 2023, GDI was nowhere near GDP, and they're supposed to equal out. One is a check on the other. And we noticed in 2023 that the two did not meet. GDI did catch up a little bit towards the end of the year and into the beginning of this year. So I don't know if those revisions I'm talking about will happen for this year, but they might. But that's another reason why I think 2023, there's definitely going to be either a revision to GDI or GDP, because the two were more than a point apart, and they're supposed to equal. One is all goods and services from the point of the seller. One is goods and services from the point of the buyer, and the sums should equal, and they did not.
Good to know. All right, we're running low on time. We're going to try to get two more questions in. First one is some bellwether. How do these data impact option strategy? Is there any particular consideration, especially for leaps and long-dated options? Any thoughts on that, Steve?
Well, I don't think anything. I mean, you can play the short-term event through the options market the way you would any stock, except you have a little more. You get a little more bang for your buck, let's say, in the options market, because you have to lay out less capital. But it's the same play. If you want to play the S&P 500, you're going to play a corresponding ETF through the options market. I mean, it's. I don't think it changes what you're doing in that regard. And as far as leaps are good, but they're speculative. I mean, I don't think. If you have an idea for long-term monetary policy, if you think you know where the economy is going or what the Fed will do in response, yes, you can probably play the index ETFs through on a leap basis. But I don't know if again, that's more speculation than anything else, I believe.
All right, we're going to squeeze one more in. I love Slaya. Does inflation data cause volatility in the stock market? We may see this today. Who knows? What are your thoughts on that? Historically, what happens?
Most definitely, inflation data causes a lot of volatility in the stock market. It causes increased volumes. Because the folks know that the Fed watches this, and the Fed and the FOMC will take this into consideration at their next meeting, it does impact policy. I think that it probably takes on an outsized importance in the marketplace than any individual meeting should. On the whole, yes, a series of meetings or a 3-month running average of CPI reports matters greatly. But I think on an individual report basis, it probably matters much more to the markets than maybe it should. And that's partially because the markets, you got to remember, price discovery in the US and everywhere else probably at this point is run by keyword reading algorithms. It's not run by guys from Brooklyn and Queens beating each other up with colored jackets anymore. And those kinds of guys would try not to get taken advantage of, and they might walk away from a price. But algorithms will just race each other to the point of sale. And if the first algorithm takes the first offer, the second algorithm takes the next offer, and so on, and it creates a false momentum that you didn't have in the days of human beings.
All right, well, we're going to end it there. Thank you so much, Steve. Check out Steve every market day on the Moo community under the Invest with Sarge handle. He can take some of your questions. I think we missed 1 or 2 questions. He'll try to answer them this week. And check out Moo every day for the latest news and information about the markets. I'm Jerry Cronenberg. Thank you so much for watching. Have a great trading day.